Hi everyone, it's Blandon here from iRefi Mortgages. Today I want to share with you how you can unlock infinite borrowing capacity. So this is a very simple concept, but a very profound one that sort of changed the way I think about property investments, and I hope that you find it helpful as well. One of the major problems that investors that come to us that they get stuck on, even though they've built up a lot of good equity, is that they run out of servicing capacity. So they can't borrow more to buy more properties. So if I was to sum it up on how you can solve this, is if you can buy properties that's going to give you 11% gross yield at the end of it, it doesn't hurt your servicing capacity at all. So what that means is you can borrow more and more and more as long as you can keep achieving 11%. So how do we come about this number? It's very important to understand how the servicing calculation works at the bank. Now, I'm just using estimations here, but all the banks sort of calculate very similarly. There are three major components in the servicing calculation. Now, the first one that you will come across is they always ask about your income. Now, even though you might have, $1 million equity, they're still going to work out whether or not your income can service the new loan. So there are two types of income that you can use. The first one is net income. So this is like your salary or your business income. They can use the net figure on a yearly or monthly basis. Now, the second type of income that they can use is rental income, or sometimes even border income. Now, with rental income, most banks will shade it. They either shade it to 75% or 80%. What that means is if you get $1,000 rent, they will use $750 or $800 depending on which bank. The second biggest component that the bank looks at is your living expense. So what is living expense? Basically how much it costs you to live. And they use an average figure even if you tell them you spend only $1,000 a month. And you eat mee goreng every night. But as soon as you disclose that you've got 2 adults and 2 children, the rough figure that they're going to use is around $2,500 for your minimum expense. So this is one of the components. Now, the second component for your living expense, and this is often what trips up a lot of clients, is that this fixed commitments. So what are these fixed commitments? They're three main ones, I would say. The first one would be childcare expense. Often for a lot of clients, maternity leave, they might have $1,000 or $1,500 a month, which can hurt the servicing capacity quite a bit. The second component is insurance. So very obvious, life insurance, house insurance, those kind of things. And the third one is other finance commitments. So even a credit card is something that would be accounted for. So for example, if you keep a $10,000 credit card limit, even though you pay it off every month, the bank is still going to use that as part of your expense. So a rule of thumb, if you have $10,000 limit, the bank is going to reduce your borrowing capacity by about 4 times. So 10,000 being 40,000. And then the last component is what we call uncommitted income. So what is this? This is basically looking at your income minus your expense. The leftover is what the bank will calculate how much you can borrow. Okay, so how do they calculate this? So just to give you an example, if you want to borrow $1 million, the amount of uncommitted income that you need to show over and above your living expense is $6,820. And you go, whoa, how do we come up with that figure, $6,820? So this is another very important thing to note about banks, is that even though the interest rate is 4% at the moment, they are always going to increase that interest rate just in case that interest rate rise. So they normally will calculate the $1 million that you want to borrow on the principal and an interest repayment, as well as putting up the test rate to around 7% plus, and it's slightly different for every bank. Now, about 6-7 months ago, like banks were still considering existing repayment amounts on your investment property. So a lot of people were able to borrow a lot more back then, but now there's only Bank of China that is using existing repayments for your existing rates. So long story short, they're going to put all your debt into the calculator and they're going to put it on principal and interest and test it on 7.25 to make sure you can service it. So that's how this figure come about, 6,820. Now, because it's rental income, if you remember what we were talking about is that the rental income gets scaled down. So what we need to do is just pretend that your income is just sufficient for your living expense and you're trying to borrow money to invest, and the only income that you can use is your investment income. So if we use the 6,820 just as investment income, we actually need to divide that by 75%, which is the shaded amount for rental income. All right, so if you divide this by 75%, you would need to show rental of income of 9,100 roughly per month to service this $1 million. So again, in summary, to borrow the $1 million with just rental income, you need to show $9,100 per month. And if you times this by 12, it's just under $110,000 a year, which is 11% gross yield. All right, so that's how we come up with this 11%. Now, naturally, the next question is how. Now, since the LVR rule came about with the 35% or the 40%, it's been a lot harder for investors to build up that equity a lot quicker, because it used to be 20% and you were able to maybe renovate and then buy undervalue. Then you've got 10% from the undervalue and you've got 10% from the renovations, and you were able to cycle your equity out straight away. Now you've got to be a lot more creative, and it's just trying to figure out what can you do or how can you achieve 11% cash flow at the end of your project, and also how you can build up 35% equity. So that's $1 million question. And if I knew the answer, I wouldn't be speaking to you right now. But it's something that we can all put our brains together and figure out as investors, and how we can achieve that. But the closest strategies that I've come across has to be things that sort of involve subdivision and relocatables, because there's a lot of untapped equity that you can unlock later on, that you can release by doing the project itself. So what I've done here down below is a link to a servicing cheat sheet. So it might help you to work out how much you can borrow. You can build a spreadsheet that's got some figures for you to remember. And I've also put 2 case studies down below if you want to learn more. One called how you can become mortgage free 10 to 20 years sooner without sacrificing your coffees and the things that you really, really enjoy. And the second case study is sharing 3 of the most effective property investment strategies that we see our clients have used in the past. Hope you enjoyed this video. Talk to you next time. Cheers.